Hello and welcome to this session. Today what we are going to do is have a look at positioning. We're going to explain what we mean by this, and then finally we'll take a look at how we start constructing our market maps. So first of all, positioning. Now we've looked at targeting a specific segment within the market, but now managers must look at how they can influence their position in the market. And what we mean by positioning, this is how a company wants its products or services to be perceived by customers relative to their competitors. And the position in itself will be influenced by the business's decisions, but ultimately it will be from the customer's perspective. So when we look at the different influences there are in positioning, we've got potentially the strengths and the competencies of the business. So what is the business's core competencies? What are we good at? Do we have a product or service that is differentiated? Are we strong within our customer service? But remember, it's also in respect to our competitors. So we need to know about what our competitors are doing. What about their product offering? What are our competitors' advantages over us? Do they have a good level of customer service? We can also look at the external environment as well, so looking into our pestle factors such as political, economic, social, technological, legal and environmental. And finally, what different resources do we as a business have access to? Do we have a lot of money in the bank? Do we have a lot of cash? Or do we have a lot of skilled employees who are able to deliver a good level of customer service, who are able to produce a really good standard in terms of the product or service? And then the main method of basically how we begin to identify our position in the market is that we look at our market mapping. And the market map will essentially put us in a position in comparison to our competitors. And we'll take a look now at what we mean by a market map. So to define what a market map is, it is a visual tool that will help a business understand their position of different products or brands within a market, so in respect to their competitors. And when we are building this market map, there will be two main variables that we will use in order to try and categorize different businesses in different areas. Some of those variables could be to do with the price level. So is it a high and really expensive product, or is it fairly cheap? We've got about the quality as well. Do we have a product or service which is high in quality or in low in quality? What about the level of innovation? Does the product or service have new, unique features, or is it fairly standardized and similar to other products and services within the market? We can look at it whether it's a luxury or necessity. So, are we trying to target the high-end wealthy consumers? Our product is packed full of, designer brands, really expensive goods, or is it a necessity where we need those things each day as customers? What about the level of customer service? Do we receive, constant support from the business? Are they always on hand to pick up the phone and support the customers? Or do you only get an email every so often? And what about the level of tech within the product? Is it full of high tech or is it low? And then finally, what about our product range? Do we have a wide and extensive product portfolio? Or do we just have a couple of products on the market? Now, the main two variables that you'll see with market mapping is normally to do with price and with quality. So let's take a bit of a look at a market map to do with chocolate brands. As we can see, our two variables, we've got price, which is high to low, and we've also got quality, high to low. So for example, these are just some products of chocolate brands that I've just put onto here. On the low quality, low price end, we've got our Freddos, bit more in terms of quality, Milky Way. Then we've got our Mars bars, Galaxy and Kit Kat within the mid-price, mid-quality range. And towards the top end in terms of high price, high quality, we've got our Lindors, we've got Toblerone, we've got Ferrero Rocher and Hotel Chocolat. So we can see there that depending on where we are in terms of our price and quality will be how we begin to position ourselves within the market. So that Hotel Chocolat versus a Freddo, they will be targeting very different customer bases. And what a business will try and aim to do is that they will try to find any different gaps within the market and see if they can begin to look and exploit that. So a gap within the market means that there's very little competition within that area. So looking at that, chocolate bar market map example, first of all, we've got our first gap, which is to sell really high price chocolate bars, but only have low quality. Gap 2, we've got really high quality at a low price. In gap 3, we've got a really cheap product which has fairly okay-ish quality, but still not the best. And we have to ask the question, just because we've identified the gaps, does that mean that all of those are a good thing for the business to go for? Should all of these gaps be explored? Well, let's start breaking these down one by one. So gap 1, we've got high price, low quality. In theory, high price for low quality products or services, they will lack demand. Because why would customers want to pay, extortionate amount of money just to get a product or service in poor quality? So there is a reason that there is a gap there. So just because there is a gap doesn't mean we need to go and explore it and, start producing products and services to fill that. There's a reason no businesses try and operate in that gap within the market, because it's not profitable, it's not sustainable. What about gap 2? Selling a really high quality good for low prices. So looking at this, low price but for high quality products will suggest lack of profitability and difficult to sustain. Because normally when we are producing these products and services which are of high quality, you have to think about the cost of production. We're using probably, higher quality raw materials and they cost more. So we won't be able to really charge a low price for a high quality good because we won't make really good profit margins. Now within our gap 3, low price but for low quality products, but once again the quality is not completely as low as Freddo's, suggests that we can be fairly competitive. And as long as the business sustains a low cost producer model, obviously referring to our Porter's generic strategies, we may be able to gain and sustain a competitive advantage. And, customers are happy because, in theory, from their perspective, the price is lower than the value that they're getting. So the demand will obviously rise for that. So by now, we know what we mean by positioning. We know what we mean by market mapping. But what are the advantages and disadvantages of using our market mapping? Well, I think the first main advantage comes from the fact that you're able to identify all the different businesses within the market. And if you do that, and there's certain gaps, then you'll potentially be able to explore these because you've identified that there's a gap within the market. So when we have identified this gap, we can look at then investing our resources, financial, personnel into that area to start producing products and services. As well, we can begin to identify actually if there's no gaps at all, if there is just too much competition, the market is becoming too saturated, maybe exploring or expanding into this market is not the best idea. And we can look at alternative methods of growth referencing our Ansof's matrix. As well, what's good is that we can start to analyse what our competitors' activities and offerings are. So what we looked at earlier was a price versus quality, two variables. So we can look at, well, what are our competitors trying to do? Are they trying to offer really good quality for reasonable prices? Then that's going to be their competitive advantage and their unique selling point. And finally, it just helps us understand the consumer preferences and market trends within our industry. Because depending on where majority of businesses are operating in, within that low price to low quality up to the high price, high quality, we can see what consumers prefer to buy. However, there are certain disadvantages and drawbacks when it does come to market mapping. I think the main one is that we are just trying to categorize the market itself by looking at just two very simple variables, price versus quality. But this might begin to oversimplify, the market and industry itself, because we can start to look at including a third or a fourth or a fifth variable. And if you was to do that, then that can become fairly, complex. So as decision making, just by saying, oh, there's a gap in the market there, we should explore that, it may just oversimplify it ever so slightly. And as we said earlier, just because we do identify that gap in the market just does not mean that we will be successful. I think we said earlier about selling something for really high price but a low quality is not a sustainable gap for us to explore. It depends as well on the accuracy of the market map. So you saw that I put what I thought to be high price, high quality. for our different chocolate bars earlier. Now that is slightly subjective. The pricing not so much, but the quality. Because you might say, actually, I don't think Hotel Chocolat, they're not really the best quality chocolates on the market. And then we start to have this subjective debate, and there's potential for bias when constructing our market map. And as I said, it does require obviously up-to-date data with the pricing and obviously with where the quality, the innovation level goes in terms of our variables. But if we don't have that, then it can lead to poor decision making. And it's also as well, these brands may decide to change their position within the market over time. Mars may want to become more of a luxurious brand. But of course, our market map is that static representation. It doesn't account for the market changes. Thank you so much for watching this session on positioning. I hope this helped you understand what we mean by market positioning and of course, how we use our market mapping. Once again, thank you for watching and I'll see you in the next one.